The Money Show.
Personal Finance with Warren Ingram.
The Personal Finance feature is brought to you by Sanlam Corporate. They take employee benefits personally, because when you care, everyone benefits. Sanlam Corporate. Good to have Warren back with us, certified financial planner at Galileo Capital. How's it, Warren? What to think about when buying a new home? I thought you didn't believe in buying homes.
I do, Stephen. I think if you're going to stay in a house for 8 years or longer, probably 10 years or longer is to be safe, then you should really think about buying a home. But it's something we always need to talk about, because there are a lot of people in South Africa who just can't get away from bricks and mortar. It's the thing they want to buy more than anything else. So we need to help them think about it.
It's also, no matter what happens, it's such a big commitment, a 20-year commitment. There's so many different factors that can really make a big difference.
Yeah, I think for most South Africans, buying your home is probably the biggest transaction we'll ever do, biggest financial transaction we'll ever do. And so, a lot of the time when you talk to people that have bought homes, that they didn't know what they didn't know. They fell in love with the place or rushed the deal, etc. And so it's, for me, it's something where if you're going to make this kind of a commitment, you should do it. There will always be emotion involved. You have to live in the place. You have to enjoy being there. But before you allow yourself to get involved emotionally, you have to have some pretty good idea of the financial implications of what you're going to do, and make sure you've done your homework, you're financially prepared, psychologically prepared, because there will be shocks along the way, and make sure that you can deal with those shocks as they come.
Okay, let's get into some of the costs, and quite a few costs are up front. And you don't always think about this when you're looking at a house and you're looking at the price and you're thinking, well, that pool, I could make that bluer than this guy has it. But the upfront costs are really, even if you get a big bond, really more than you would expect.
Yeah, I think it's one of those things where we kind of think, if we can convince the bank, with our first bond, the first time we buy a house, to convince the bank to give us, 100% bond, that we've scraped together some cash, and that'll be okay to get through whatever the costs are that we need, and then we'll start, the following month paying down the bond, and everything will be okay. I wish it was that easy. That's not really the case. So we need to prepare for a few costs when we're going into buying a house. And when I say house, it could be a house, it could be an apartment, in an estate, etc. And the first thing is, there are always lawyers involved in the process. And so when you register a bond on a property, for example, you go to a bank and you say, will you lend me the money to buy this house? The bank says, sure, no problem. What happens now is the bank becomes, in essence, the real owner of the property until you've paid it off. And so what happens is they appoint a lawyer who registers a bond on the property, and that bond says that yes, Warren is the person that's names on the title deed, but alongside Bank ABC. And until such time as Bank ABC says differently, Warren can't sell that place without the bank's approval. So there is a bond registration process. And then that's not the only thing, because we also have to pay some tax. The SARS is not going to let you buy and sell properties along the way without trying to claim some money as well. And so if you've got a property and it's worth more than 1.2 million rand, then you're going to pay bond fees and you're going to pay transfer fees to SARS as well. And so just be careful there, because those transfer costs can add up very quickly. And I did a quick calculation. I'm not pretending to do this in my head, but for around a 2 million rand property, these upfront costs are going to be pretty close to about 120,000 rand when you go in. And for a 5 million property, it's going to jump significantly, around 500,000. So that's the lawyer fees, it's the taxes to SARS, the transfer duties. So all of those costs are hitting you up front before you've even paid for the geyser, which is probably going to burst on the first week that you move into your property.
Only if the mother-in-laws come for tea, Warren. Okay, you can get 100. There was a time when you could get 101, 102% mortgage. I think those days, thankfully, are long gone. But even if you get a bond for 100%, should you still consider putting down a deposit? Is there a gain to you in doing that?
I think it's the trade-off between, what can you do upfront on a monthly basis? How much have you saved? Because the moment you put down a deposit, the benefit to you is that your either you keep your repayments a bit lower. So if you owed, let's say it was 10,000 Rand a month, but now you put down a deposit and it's a decent deposit, you might find that you only need to pay 9,000 Rand a month. And so that's the one way of saving yourself some money on a monthly basis and creating a bit of space in your budget is put down a big deposit, and the bigger the deposit, the smaller the monthly repayments. The alternative is that you put down a nice deposit and you don't pay less. In other words, you still pay your 10,000 Rand a month. And if you do that, you're going to take years off the life of the bond. So most of the time when we get a bond in South Africa, the banks will give it to us for a 20-year period. And the bigger the deposit on day one, and the more consistent you are in paying a bit extra every month, you can start to cut off periods of 6 to 8 years on a bond just by paying a deposit on day one. And so I mean, to me, I think the other thing around a bond and maybe paying a bit extra is it becomes a very nice place to build up an emergency fund, because you're going to need an emergency fund when you own a property. So if you view nothing else, then pay the extra money that you would have stored for your emergency fund as your deposit, if you can. And I think maybe my last comment there on this, Stephen, is you just make sure with the banks that this is, if you pay the extra money into the bond as a deposit and it's more than what they require, that you can draw out the extra money when the world falls apart and you need that money for an emergency.
072 702 1702. What did you learn when you bought a home for the first time that you didn't know before about finances? Now, I don't mean check the outside loo. I do mean about finances. What did you learn through the process? The other thing is, and I mean, I remember going through this, you need to know how much you can actually pay every month. And sometimes that can be quite hard to work out.
Yeah, I mean, certainly as a recovering property buyer, this was the one that caught me out. I think I did very well on understanding the upfront costs, and I had a nice emergency fund. I did put down a deposit, and then sort of by the second or third month of home ownership, I just realized, the money's so much tighter than I thought it would be, and I didn't really understand what was going on, and so just to think it through, the first thing is you've paid tax to SARS on the transfer duty, but now that you're a homeowner, you've got a new government body that's involved in your life, and they don't go away for the rest of the time that you own a property. And that's called the local municipality, because they want to charge you something called rates. And the reason they charge you rates is because they're going to provide services like sewerage access and refuse collection and all of those things. So for that, they're going to charge you a monthly rate. And in certain areas, the Western Cape is one of them, those are going up fairly quickly. And so again, you need to know that, it's not just, your monthly bond, it's now these rates. And, year one, once you've done the homework, you might say, okay, well, that's fine. I can pay the rates, as they are now. But if those rates are going up faster than inflation, then you need to have an extra amount saved for the following year, because these rates are only ever going to go up. And in addition to rates, if you live in an apartment or in an estate or a townhouse and you're part of a complex, then you're going to pay rates and you're going to pay a levy. And that levy goes to the body corporate or the homeowners association. And the reason you're paying them is because they will have responsibility for certain parts of the building on the outside. So for example, in an apartment block, the body corporate will be responsible for maintaining the roof and the building on the outside. And so, every number of years, they're going to paint that. They're going to have to redo the paving every now and then and make sure the roof doesn't leak and all of those things. And so you pay a levy to them as well. And that's not a negotiable thing. That's not something you can decide to pay or not. If you're an owner, that means you're a part owner of a whole building and you are expected to pay. And if you don't pay, you're going to get yourself into even deeper financial shtuchers than what you thought. So make sure that you pay these things, because you've got to pay these. This is not something you can just avoid or ask for a payment holiday.
Mm. And I mean, those can, even when you've been living in a place for a little while, suddenly there can be increases. You can want to boom off the area, or something like can happen, or there's a regular cost, or a community fund, or a something. Those things keep coming up. They don't just stop.
Yeah, and it's often at the very worst time. I remember living in a body corporate where the trustees said, "Look, we've run out of money, and we need to repaint the whole of the outside of the buildings, including the outside boundary walls, etc. They're in desperate need of paint, and so yes, your normal monthly levy is 2,000, but unfortunately, for the next 3 years, we're going to charge you another 2,000, and that's called a special levy because they didn't budget for the stuff up front. So now we need to paint and build up some money for those costs. And again, it's not a negotiation. Once the homeowners have decided, and at a trustee level they voted for this, it's a cost you have to pay. You have to share that burden. And so maybe a good kind of tip for first time buyers is, before you buy into a body corporate, ask them to give you the financials of that body corporate. You want to know that it's in a healthy financial position, that it's got some emergency reserves. Otherwise, you're going to be part of the emergency reserves problem in the next month or year ahead.
We have a question for you from Titus, Warren. Titus is asking, I'm thinking of swapping my hospital plan for health insurance because it's cheaper. Is this a good idea? It's such a wonderful question, this. Also, what did you learn buying a home for the first time? 072 702 1702. We'll have an answer from Warren in just a moment.
The Money Show. Personal Finance with Warren Ingram.
Well, your question, Warren, from Titus, I'm thinking of swapping my hospital plan for health insurance because it's cheaper. Is that a good idea? I mean, people go back and forth on this question all the time.
It's such a tricky one because I think it's for me, intuitively, I would say the last thing I'm going to do is cancel my hospital plan. And the reason is because if I have an accident, I want to know that I can get care in a hospital immediately, and that I will be covered for all of the expenses while I'm in the hospital. And that might include having to pay surgeons and specialists and all of that. And hospital plans are not famous for covering all of the costs 100% of the time. But what I will know with a hospital plan is that I'm largely covered for most of the expenses. And so almost my default answer is that I would be very scared to cancel a hospital plan. But one of the things to think about is, health insurance, it typically doesn't really cover much of what you would, much of the expenses when you are in hospital itself. What it does do is it helps you when you're going to the general practitioner and you need to go to the doctor because you're sick, and it covers you more for the things that happen to you day to day when you're not having an accident or something like that. So for people that that maybe are in a position where they've got a family and they end up at the doctor reasonably often, then you might find that health insurance covers them a little bit more. But I think it is a tricky one because those are expenses. Obviously you can't negotiate with the flu. If you're sick, you're sick, and you need to go to the doctor. But at the same time, I think for me, I want to know I'm super well protected when I'm end up in real trouble, and I need to go to hospital and be covered for that. So. I almost want to say, if you're looking at canning your hospital plan just to save money, sometimes the health insurances or medical insurances are actually a little bit more expensive than a hospital plan. So just be careful that you're making an assumption there, Titus, that the one is cheaper than the other. And then, just be very clear that, if you cancel your hospital plan and you have an accident, you're going to a state hospital. And there are some very good state hospitals, but unfortunately, there are also lots that aren't that good. And is that the kind of risk you want to take with potentially with your life without being too dramatic?
No, sure. You really do need to be very careful, and you can have, you break a bone or something. There'll be long-term consequences if things aren't sorted out properly. Warren, we've got one or two questions, one or two comments coming through on 072 702 1702.
Hi, Stephen. Just ask Warren, let's say a 2 million bond house, deposit of 500, or you sign up the full 2 million and put a lump sum of 500. Is there a difference in terms of your saving on your on the interest. Yeah, just wondering, Jimmy Mindra.
Thanks, Jimmy. Warren, yeah, I think this is about sort of investing 500,000, or is it about putting it into the bond?
I love the question. So I think if you're gonna take the 2 million bond, so you get 100% bond, and then sort of day 5 you take your extra 500,000 and put it as a top up payment into the bond. So now you've got a very big down payment as an additional amount that wasn't contractually required. It does give you a huge amount of flexibility. So number one, the amount that you owe is now only 1.5 million, and so the interest that you're going to have to pay over the life of the bond is less. And then you get into that that position where you can either maintain the monthly amount on day 1. So if they said to you on 2 million that it was for example, 20,000 a month, you could say, well, even though I only now owe 1.5 million, I'm going to keep paying 20,000 a month. And you might find that you end up paying that bond off over a period of 8 years or something, not 12 or not 15. Alternatively, you might put the 500,000 in and then get a lower interest and a lower payment, and then you decide I'm going to pay that minimum. So I think it's a nice idea. The one thing I would do is I would check with the bank. If you say to them, this is a 2 million property, I'm willing to put in 500,000 up front, what would be the interest rate you're going to charge me? So sometimes banks will actually view you as a better risk, and if you're a better risk, they might reduce the interest rate. So instead of charging you prime, they might say to you, we'll charge you prime -1 if you put down a big upfront payment as well. Unfortunately, you can't access that money. So once it's in, it's in. So I prefer the flexibility of the first option of getting the 2 million bond and then doing a 500,000 payment after that, but not at the expense of a very nice interest rate from the bank.
You really got to do a lot of longer term maths. All right, there's a big debate about deposits. So it sometimes depends on where interest rates are. You're going to have to explain all of that to me because there are a lot of different variables here.
So, I love the stock market, Stephen. So if we use the stock market as the alternative, the thing you can do, the other thing that you can do with your money that's sensible for growing your wealth, we would expect the stock market over long periods of time to give us, let's say, 10 or 11% a year over a 10 or 20 year period. And so if someone says to me, well, I'm just going to pay the minimum on my bond and I'm going to invest the balance, the first question I would ask as a follow-up is, what is the interest that you're paying on that bond? Because if the interest rate is 11% and you can expect to get a return of 10 or 11% from the stock market, then I'm going to question that decision because, if you pay extra money into a bond, I view that almost as a guaranteed return, which is tax-free. It's almost like a guaranteed tax-free investment because the more money you put into the bond at 11%, you're saving yourself that interest that you have to pay. And so, if you turn it on its head, it's almost like, saying, well, I'm going to get, a guaranteed saving of 11% and I'm not paying tax on it. So I think then, paying a big deposit when interest rates are very high makes a lot of sense to me. And paying as much as you can extra every month would make sense as well. But there are times that, I know it doesn't feel like it anymore, but there are times when interest rates might only be 8%. And then it becomes a little bit more tricky because, if you can get, 3 or 4% more than the interest you're paying from a stock market investment, perhaps you want to balance the two and say, I'm going to put some extra into the bond, but the other portion I'm going to, put into an investment for the long term.
And I mean, what you want to do also, I know some people who just can't stand debt, and I know some who are very comfortable with it.
Yeah, I'm that guy, Stephen. I don't want to be told what to do by outsiders. So I don't want a bank to tell me, that I owe them. So I'm going to pay off that debt as fast as I possibly can so I can sleep at night. And so irrespective of the interest rate, I'm going to get that bond to zero as fast as I possibly can, and then save as much as I can in investments going forward. So that's a personal preference for me. But there are other people out there that would be very happy to have a bond for 20 years and would pay out, pay the minimum or slightly more, and then invest, alongside, because they feel that's diversification. And I think the important thing about money is that, there isn't always only one way to do everything. You have to match it to your personality as well.
Warren Ingram, thank you so much. Really do appreciate it. The co-founder and certified financial planner at Galileo Capital.